I'm making this video because a client of mine that recently purchased a business asked me to kind of show how the taxes kind of work and also the cash flow of the business. So hopefully this makes sense. So this client was a healthcare professional. We'll just say that their salary was $180,000 gross, or that's what their salary is. And their unemployment taxes and payroll taxes, which include Social Security, Medicare, are about 20%. I just put 20%. We can change this to 18%. Doesn't really matter. This is hopefully just helping you understand the concept of it. So these taxes are taken out automatically. These federal taxes and these state taxes are dependent on how you fill out your W-4. In this scenario, I just assume that the federal taxes on 180 grand is about 15%. It's probably really closer to 12, so I can always change that. But we'll just call it 15%. So each paycheck, $2,250 is getting withheld and going to be paid to the IRS. And then $375 is going to get paid to, in this scenario, this client is from Arizona. And so they're going to get $375 paid to the state of Arizona. And so their net paycheck each month is going to be a little over $9,000. Over the course of the year, they should net about $112,000, and all these taxes are paid for them. And assuming this is all accurate, when they file their taxes, let's just assume these percentages are exactly the same. And so at the end of the year, they'll pay $27,000 in federal taxes, $4,500 in state taxes, and they don't owe any taxes. So they netted $112,500 after taxes. So in their personal bank account, that's what they should have, assuming they didn't spend any money. So that's what most people are used to if you are a salaried employee. Taxes get taken out, you get the net paycheck, you don't have to worry about anything. However, when you become a business owner, things change a little bit. And so this client purchased the business, and the business income total was $540,000 for the year, or we'll just call it $45,000 each month. And they're going to pay themselves a reasonable salary, which we determined was $180,000. So every month, we'll go month, $45,000 in, we'll just call it net business income after all expenses. Then he still has to pay himself. And so the business nets $30,000. Out of the paycheck, we're still assuming 20%. So his monthly paycheck is $12,000. He also has a debt payment, we'll just call it $15,000 to pay against the debt that he owes because he borrowed money to purchase the business. And so your monthly cash flow personally is still $12,000. And the business retains $15,000 because they had $30,000 minus $15,000. And that's the same for the first 3 months in this scenario. In April, and also under this scenario, the paychecks don't pay any federal or state taxes. This is just an example. And so they could not pay any federal or state taxes each paycheck. And then they can pay quarterly taxes towards federal and state. And so in order to pay these amounts, they have to distribute money out of the business account to their personal account, hence why their monthly personal cash flow is $52,000 because it's the $12,000 from the paycheck plus an additional $40,000 so they can pay off this $40,000 quarterly estimate. And these 4 months are the only ones where they get an additional distribution or a distribution so they can pay off their quarterly taxes. So that's what would be different for a business. You could also not pay as much each quarter and have similar amounts come out from your paycheck. We'll just assume that we're going to take out 25% from his paycheck and 2.5% for state. But this is all just based off of his salary. So that's $45,000, we'll just call it $3,750, and $375 we're going to get taken out of each paycheck. So his net paycheck is a little under $8,000. However, his quarterly estimates are going to be lower than what he had before. So it all depends on the client. There's different ways to do it because at the end of the year, assuming these percentages are correct, that he's got to pay 25% in federal taxes, 2.5% for state taxes, it doesn't matter if he pays federal and state taxes throughout his paychecks, the net amount is still going to be these amounts for federal and state. Because if we go back and don't pay any federal state taxes on his paycheck, he just pays larger amounts each quarter, and he's still good because he still ends up paying the same amount of money. And then down here, I kind of just show kind of like the personal bank accounts of what they actually have, because these numbers also don't change as far as those don't change, because business income, the tax that paid out, the debt payments, combined with their personal accounts and business accounts, this is how much they should have in their bank account, assuming they don't spend any money personally, but that's obviously not the case. So hopefully this helps out for people that it doesn't necessarily have to be healthcare professionals, but when you're used to getting a W-2 paycheck and then you transition to being a business owner, there's different ways to have your taxes paid for and also the cash flow. And keep in mind, these distributions, 99% of the time, it doesn't affect your taxes because you're just taking money out that you're already going to pay taxes on. The only time you run a scenario where these potentially could be taxed is if you don't have what's called basis. And that typically happens when you borrow a lot of money. Even though he borrowed money for this business, he's still making more money than he is borrowing, so to speak. So these amounts are essentially tax-free. Well, he's already paid tax on it, and this is money that's taken out after taxes. Let me know if you have any questions.